Hello, we are International Hospitality Media, or IHM for short. IHM is the #1 brand to engage with decision makers in hospitality and real estate. Our 4 multimedia brands lead their respective sectors with breaking news, comments, trends, and opinion across a variety of multimedia solutions. We provide an inspirational community to connect people through world-class events, webinars, podcasts, award schemes, and much more. But let us share our story of who we are and what we do. Over 10 years ago, Piers and George had a light bulb moment to provide expert opinion, comments, and no-cost digital content. And so they went on a journey over the past decade, creating media platforms to serve the hospitality and real estate industries. We now have an engaged audience with a reach of over 60,000 monthly visitors across our websites, 41,000 on our email database across all the sectors, and over 67,000 across our social channels. Everything we do believe in challenging the status quo. We believe in thinking differently. We make things simple and very easy to work with us. And we're a friendly bunch too. We offer creative solutions to help you achieve your business goals. Read, watch, listen, meet with IHM. Contact us for a chat today. Just look at some of the brands we have worked with recently.
Welcome everybody, and thank you for joining us today. Hope you all had a wonderful Easter break, and we are now very much back to reality. In today's topic, we are talking about more stressed owners, more distressed assets. For those of you who don't know me, I am your host for today. My name is Eloise Hanson, and I'm the editor of Boutique Hotel News. We are a global B2B multimedia platform covering the boutique, lifestyle, and luxury hotel industry. We have a couple of sponsors for this webinar series, the first of which is Like Magic, which is a smart hospitality tech platform. And we have a short video to play for you so that you guys can learn more. You can find more information about Like Magic in the chat. And our second sponsor for today is London Rock Partners, and we have the company's Chief Commercial Officer, Claire, who's also speaking. She's involved in today's conversation, so let's hand it over to Claire and she can tell you more about London Rock Partners.
Thanks, Eloise. My name is Claire and I am the co-founder of London Rock Partners. We are a UK-based hospitality management company who started out 2 years ago. We came to the market to offer a more flexible, agile solution to the traditional hotel management platforms. We specialise in working with underperforming and distressed assets. We work across branded and independent hotels and some wider hospitality assets. The aim was to make contracting terms easy and flexible, in line with the fact that now the hospitality sector is moving at such a fast pace. We currently manage across brand and independent, Hilton, Accor, as well as a new build 5-star property in the Northwest. We have an active pipeline and would be delighted to talk to any owners or investors offline. My LinkedIn profile, I believe, is in the chat, and I look forward to talking to you today. Thanks, Eloise.
Brilliant. Thanks a lot, Claire. And now that we have met Claire, let's meet our other speakers for today. So I'm going to be handing over to Desmond next for an introduction. Welcome.
Hi, can you hear me okay?
I can indeed.
Good. Well, good afternoon, everyone. My name is Desmond Taljaard, currently MD of L+R Hotels. We have about 115 hotels globally across Europe, UK, and Europe. We operate about 90% of those, some of them through brands, some of them through our own independent boutique identities, and very pleased to be here. Thank you.
Thank you, Desmond. And over to you next, Sabine.
Yeah, thank you very much, Eloise. So my name is Sabine Schäfer. I'm CEO of ProInvest Europe. ProInvest was set up some, 13, 14 years ago in order to focus not just on the asset management as well as the day-to-day operations of hotels, but also, we're covering the development side. So effectively, it's an integrated platform from our founder, Ronald Barrett, who used to, prior to ProInvest, very successfully build up another company called Stenifer, which eventually, Stenifer Hotels eventually became Atlas, the Atlas Hotel portfolio, which Desmond is very much aware about. So we're now covering about 6,000 keys and very much, I guess, a very private equity-like, approach. Although, as I said, it's the heavy lifting that we quite like to engage in. So whenever times or opportunities are a bit more hairy, quote unquote, that's when we believe our expertise and on the operations side and on the development side, we can bring that to bear.
Brilliant. Thanks, Sabine. And all the LinkedIn profiles of our speakers today have been popped into the chat, and I would certainly encourage our audience members to connect and carry on the conversation even after we have finished up here today. So to provide a short overview of some format today, we're going to spend around 45 minutes in discussion, followed by some time at the end for any questions from the floor. So audience members, if you have any questions for any of our panelists today, please submit these using the Q&A function, and I will get round to these as and when. And a gentle reminder that this webinar is being recorded and will automatically be sent out to all those that have registered within a couple of days' time. Now, to set the scene for this webinar, I always like to provide some context, some food for thought. And on this slide right now are some recent transactions over the last 6 months that we've covered at Boutique Hotel News. So over in the US, we've got Highgate and Flynn Properties, which has acquired the Huntington Hotel in San Francisco. Aprose has sold the Queen's Hotel in Leeds to Pandox. Sidon Hospitality has bought the Pullman in Cannes. Battle Hotel Group has bought the Grand Hotel in Brighton, not long after a London acquisition. And looking further ahead at future acquisitions, PPHE has launched a €250 million fund to accelerate its acquisition strategy. Now, on the next slide, in February this year, we ran a story from UK Hospitality, which revealed that 32% of hospitality businesses are at risk of going under this year, despite sales from 2022 topping pre-COVID levels. And contributing factors included cost pressures, labour shortages, and COVID-19 debt. And it's because of these financial pressures that the Lomond Hills Hotel in Fife ceased to trade last month. And I understand that that property has now been brought to market. And on the final slide, reports from the UK and the US show a strong rate recovery for hotels, with the majority of boutique hotels in the US achieving RevPAR recovery. Here in the UK, room rates have increased by 13%, but in both markets, occupancies are yet to reach pre-pandemic levels. So all of this considered, there are a lot of factors at play here for owners to consider. So let's kick off our main conversation, and I'm going to come to Clare first. How is L+R Partners adjusting for inflation?
I think when it comes to looking at the increased costs, it's not just inflation, Eloise. And everyone on this webinar will know that it's looking at the food costs, it's looking at the increased beverage costs. It's the increased cost of labour with the minimum wage changing again in April. It's the cost of utilities. There's a lot that goes into that kind of the challenge we find ourselves with now. And I think from an operator perspective, We break it down into two clear sections. One is leisure customers and one are corporate customers. When it comes to leisure customers, we have been very successful in passing that cost on, passing that increased cost on to the customer. And I think that at the moment we're in a short window of time where that is acceptable and very palatable to the leisure customer. They very much understand that there is an increased cost of living. They very much understand that everything at home and domestically is more important. So therefore, there's a bit of an appetite to expect that when they are travelling. And we have seen that reflected in our leisure rates, as per your previous stats. My concern is what happens when you reach that ceiling, but for now, it's driving rate, and certainly that leisure market seems to be responding well to it. The flip side is the corporate market, where we have seen far more pushback. When we are trying to drive those kind of premium rates which sit in line with all those increasing costs, the corporate buyer is starting to push back. It seems to be far more driven by experience and kind of all the other additional items that go with that transaction. We certainly are looking at those bookings now far more in terms of total revenue than we would have done before. I think they've got less appetite to absorb the increase than the domestic traveller, which I think is why those leisure destinations are trading well, and perhaps those corporate destinations are starting to feel that pushback because there is a ceiling that you can take it to.
Could you build on that some more, Claire, and talk to us about what impact have these changes had on that recovery and what you might call the return to profitability?
Yeah, I think that I can only talk in terms of the hotels that we operate, but when we see it in terms of recovery, we have seen revenue surpass, top line revenue, surpass 2019. And in some instances, we've seen it surpass our expectations in terms of budgeting, which is brilliant. The same cannot always be said for profit. And that is, if we continue to trade in the way that we have for Q1, we've had a brilliant Q1, predominantly driven by leisure business, predominantly driven by some great half terms, as I know lots of other owners and operators have done. If we continue on that path, our profit will start to edge back towards 19 levels. But at the moment, the challenge is not with top line revenue, it all sits with conversion.
Thanks, Claire. Desmond, coming to you next on this one. We've seen that hotels have largely had a rate-driven recovery, and luxury hotels have very much been at the forefront of this, and they've been able to uphold these profit margins. But do you expect this momentum to continue, and what opportunities does this present for investment?
I feel we're very much walking a tightrope at the moment, where to echo what Claire Ann has said, we've got great strength in revenue and RevPAR, more driven by rate than occupancy, has to be said. I'll come back to in a minute. We've got great following winds in the luxury sector, which the whole sentiment of moving towards experience rather than consumption of products. The macro trends to go out and enjoy life a bit after the government enforced lockdown and some say illegal pandemic constraints put upon the hotel sector, which the government made no effort to recompense. We'll come back to that later. The very much tailored experiences coming out of the luxury personal, all about making it personally tailored and enjoying that with friends and family. So those are great following wins. We're finding that our destination hotels, branded and unbranded, for different reasons, are getting great rates at the moment. What are the headwinds against that? Well, we are seeing the rate acceleration not being maintained by occupancy. So we tend to have less corporate business driven into there than mostly leisure driven businesses, but any group functions or conferences are still somewhat suppressed. Operationally, we've got the same challenges as everyone else with availability of team, ability to attract and retain team members. Interestingly enough, the economics make it far more compelling to pay people well than have high turnover, which we've never really debated, I think, openly in our sector. So we've gone out to target not just team and staff satisfaction, but also retention rates, limiting the amount of training and turnover. When you do the arithmetic, how much it costs to train a new member coming into the team, it's a lot more efficient and economically sensible to pay your great team members well. We've been doing that ahead of ahead of our competitors during the course of the last 9 to 6 months. Clearly, those that didn't understand energy strategy being weren't really spanked last year for the government's failure to have any long-term 20-year energy strategy for self-sufficiency. And so we were lucky, but we'll claim it as judgment. We were lucky that we locked in at long-term at very attractive rates, but those were coming to an end. A lot of energy companies are choosing not to renew contracts with hotel operators because they're seen as bad credit risk. The government's failed to do anything to support hoteliers in that respect, and therefore the hoteliers are having a smaller pool of energy contractors or suppliers to access. And similarly, notwithstanding they may get access to them, they may be asked to post ridiculous deposits or other credit enhancements to get access to the same level of energy competitive pricing that some of our other sectors such as retail or offices may be attracting. We found one of the topics in our first and foremost in front of minds at the moment is what I call brand confusion. I think on the higher we go up the segment, we're finding the less important a global brand is and the more the individual personality and attributes of that specific destination and that specific assets are. And so we're almost becoming convinced that the concept of a collection of a family where you can drive CRM efficiencies and other customer appeal, customer contact benefits, but without being under some expensive branded franchise or licensing or HMA is becoming our far more preferred segment or means of operating these hotels. So I'm interested to hear what Clare said. We've actually had record profits in 2022, partially because we had great staff retention, partially because we had great energy strategy, though the latter, I'd say, was more luck than judgment, and certainly nothing to do with government support during last year. This year, we're finding rates are holding up, so we find demand to be quite inelastic to pricing. We're finding occupancy is drifting down. What we're finding is people, when they are coming, they're having a great time, but the frequency and length of stay is under challenge. So if we looked at a trend, we're probably still consistent with 2019 in terms of occupancy, thankfully way ahead in terms of rates, but the occupancy trends are giving us cause for concern week on week. That's same in London, as we're seeing, obviously coronation notwithstanding, same in London and also in our sort of great countryside destination resorts. In Europe, where we have a number of hotels like the Nobu Ibiza or Venice Excelsior, we're seeing tremendous demand, way ahead of any definition of peak years, be that 2019 or 2022. So we think people are going to get away and have a great time. Bookings are phenomenally ahead. I'm going to talk about pace. I'm talking about 25-30% ahead of last year, which was a record year. So no doubt we'll be criticised by the press for profiteering. Will be the next slander that our innocent industry faces. But so it is on a knife edge. So I don't want to paint a undue rosy picture, and the cost pressures, I think more than anything, are driving our customers to have even better experiences, but probably less or fewer of them.
Could you expand on this, Desmond? And I want to talk about this flight to quality trend or phenomenon that we are seeing. This was actually a topic that I discussed on a previous webinar about branded residences and the drive for.
Well, I think there are two points I want to make. One, I think, is the squeeze middle is getting further and further squeezed. So we, as many people know, we have segments across the entire range of hotels, from Sabine's former and expanded Atlas Group, Select Service, the largest Holiday Express franchisee in Europe, to city centre hotels, branded and unbranded, and in the luxury assets that I've just been referencing. Unquestionably, it's the middle that's been squeezed the most, primarily for two reasons, one of which is probably still oversupply in some markets. Brand relevance is a challenge to owners when the cost of branding is so expensive, and so-called brand premium is becoming more selectively difficult to prove, i.e. what you pay by the time you paid for your OTAs and your brand and your service fund system delivery, you're paying 30% of a reduced RevPAR away to people who've contributed nothing to the building of that hotel, nor carrying the employment costs and all the energy costs, all the other risks of ownership and supporting the financing costs. That can prove quite troublesome. So I remain, unfortunately, quite on the skeptical to pessimistic spectrum about the middle that's being squeezed. Where I think back to my point earlier, where people are seeking real experiences that are tailored and personal, they are prepared to pay for that quality and that experience. Select service, you look at the performances of Whitbread and Travelodge and others are doing phenomenally well as well, because people, where it's commoditized, they want good value, consistent experiences and reliable, safe and clean environments. It's the middle that I would be most nervous of. And I have been saying this, a stock clock is right twice a day. I've been saying this for 20 years. So at some stage, I'm going to be right.
Thanks, Desmond. Sabine, I'd like to bring you in here to build on what Desmond has just been talking about. And I want to bring sort of hotel valuations and the sort of the bid-ask spread into the conversation here. I mean, how do you see that evolving throughout the year, with a view to what this might mean for future stressed or even distressed acquisitions?
Yeah, sure. And I mean, I couldn't, I guess, echo more to what Desmond and obviously Claire very, very eloquently pointed out, which is there are an awful lot of headwinds in our industry currently. And while, yes, the trading performance, on the books, it looks as if, okay, fantastic, ADR is up 15, 20%. There is a lot of, I guess, behind the curtain, there are an awful lot of issues. So this is one of the reasons why, for example, the majority of the opportunities or transactions that we looked at last year, from a price perspective, we were obviously continuously about 15 or 20% below. And as a result, weren't able to proceed. And surprise, surprise, very few of those transactions actually transacted. So in other words, there is, I guess, among investment professionals, a notion out there that there's a lot of noise in the system at the moment. As a hotel owner, obviously, you're seeing the trading performance being extremely good. So, why should you take a hit on from a price perspective? But then when you look a little bit further, in particular with regards to, interest rate rises, things that are hard to avoid, and even if they now may start to, let's say, no longer continue to rise at the same speed, we will still, I guess everybody believes, remain at high level interest rate for quite a while. If you look over what happens in the US, for some people this means that kind of funding now almost comes into the double digits kind of area, which is just extremely expensive and not long-term sustainable. So I think at the moment we're in this kind of transition phase out of, an area whereby there was a lot of, arguably as well, support from the government. This was given to hotels. Now we had to, during 22, wean out of that somehow, which obviously took place. Then what we just kind of discussed in detail, all of the headwinds with regards to inflationary cost pressures, issues of finding staff, energy cost rises, which, for example, quadrupled in places like Germany. So it is something, something very serious kind of to take to heart. And then what are the banks doing about all of this, right? I guess to some degree, they learned from 2008. They're not going to try to, throw the baby out with the bath together. But at the same time, I think there's only so long that, this can be kicked down the road. So I guess all of this means what? All of this means that we do believe that, I guess, the worst is yet to come. We do believe that due to the kind of longer period of expensive interest on loans and some of the alternative financing that some hotel owners had to take on board, despite the better arguably trading performance on paper, not different from the bottom line at the end of the day, we will see more and more of those opportunities coming our way. And then, by the way, there are also, just to be clear, there are also some owners who may not be in financial distress, but who just basically decide for one or the other reason that it just may not be their industry, right? I mean, we know a lot of family offices who, for whatever reason, bought that one asset and it sounded like a great opportunity at the time, and it became a significant headache during COVID and continues to be such. So, we are familiar with some family offices who just basically say, or businesses who say, very politely, we would like to solve this maybe in a more quiet manner as well. We know about, sometimes also private equity funds who come to the end of their lifetime, so they also need to transact at some point. So I guess there's a number of different pressures currently in the system that at least make us believe that there will be, a number of opportunities in the, let's call it, distress space coming our way. And then on top of that, by the way, and this is also what Desmond said, a lot of people asking themselves questions about, what's the right business model to follow? Do I want to continue a hotel brand to operate my hotel? Or is it better if I, try to enter a franchise agreement? Or is it better to, the various sorts that we all have? And also, do I have the right brand on top of my roof, or do I want to change that? And one of the things that comes through as well more and more is that, if you're thinking of, anyway, using any international brand, all of a sudden you will be asked more and more as well to be compliant with regards to ESG requirements. And this means nothing else, but you have to put up additional capex into your hotel in order to stay somewhat, not just up to date, but to at least hold the level of valuation that you received in the past, right? So that's another area where a lot of the people who basically thought, okay, I own my hotel, I came through the worst in COVID, and I'm now ramping it up, and I'm going to sell it hopefully in the next 18 months time in kind of a ramp up kind of environment. All of a sudden the value is going to tell you, well, unless that you do comply with some level of ESG standards, we're actually going to have to use a discount to your valuation. So again, a lot of headwinds, and that means from our perspective, there will be one or the other distress opportunity coming our way. But it is not going to be just clearly like 2008. The banks are not going to act the same way. They obviously, the easiest thing for a bank has always been, you just continue to support, quote unquote, the hotel owner, restructure the financing in some way. For the banks, it also means providentially a long income stream. So it's not a hard landing from our perspective.
Right now,
can I make a
please.
quick comment on a couple of observations? One of which is just a shout out to all you valuers out there that most of your numbers are wrong at the moment. I'll give you some examples that we were reported to have sold, maybe in your press somewhere else, so we're not going to deny the reality of a hotel in London, subject to a Crown estate lease at almost £1 million a key last summer. This has been widely understood by everyone except all the valuers, who are now saying, well, that was an exceptional number. I'm disregarding that. I'm taking whatever number I thought of 2 years ago and discounting it by 20%, notwithstanding that 2022 was a record year for a lot of our hotels. So I have grave misgivings about the intentions and processes going through the mind of valuers at the moment. I wouldn't possibly think that they had some Machiavellian intention in just marking things down to cover their backside, because that would be a cynical interpretation at this moment in the cycle. But I think for all the valuers listening, you've been wrong so far of any number that I've seen in any of our portfolio. The second observation I'd make, which I think is slightly more subtle, is the distinction between distressed assets and distressed capital stacks. There are some assets that are just plain bad because they're in the wrong location or wrong quality, or not renovated, or can't compete with the evolving market, or the market's relocated, they're no longer relevant. And I would call those distressed assets. There are not as many of those around as are, I believe, distressed capital stacks. They're going to be accented or underlined by the fact you've got much higher costs of interest going up, thanks to central bankers that read no history of the long-term impact of low interest rates suddenly jumping to high interest rates. So that's causing stress. Bankers are using that excuse to put up their margins at the same time, camouflaged by the central bankers. So you've got a tripling of cost of debt. The actual the all-in costs have probably tripled or quadrupled to many borrowers. And you've got that faced with the LTV impacts from the very poor valuations coming through at the moment. So some of this distress in the capital stack is manufactured by call it the institutional infrastructure. It's not necessarily that the assets are any bad. And where we've been looking for the very few assets that have come to market that are good assets, i.e. not distressed in great locations, there is very healthy competitive demand to try and secure those assets, which apparently our valuers choose to ignore as evidence as they flow through to transactions. But we're almost going into a bifurcated market now of bad assets with bad capital structures and good assets, actually a trifurcate, I invented a new word now, trifurcate. You've got good assets with robust capital structures or do okay. You've got the really bad distressed assets with bad capital structure. You've got the in-betweenies who are, I think, going to face the challenges in the next 6 to 12 months is can they restructure their now newly expensive debt with newly crap LTVs forced upon them by the institutions. And, you know, it will be interesting to see how the bankers perform and how they respond. I disagree with Sabine. I think the bankers' behavior will be worse this time than 2008 for 2 reasons. One is that most loans will be sub 100%, and therefore the bankers who say, great, I can now go and collect my loan here. There's no risk of me having to write off any debt. I can just accelerate my loan and collect all my proceeds. So I think that's an incentive to the banks to enforce on their borrowers. So they would like to call clients and customers, but at the end of the day, they call them borrowers when they want to collect. That's the first observation. The second observation would be, I forgot what it was going to be now. It's with the global stress coming on from the Credit Suisse and whatever, banks have got a great excuse now to say, it's not me, Gov. I'm afraid my capital ratio reserves require me to collect a lot more loans in. I'm going to force everything down, 40% LTV. Don't blame me. It's not the GFC. It's the central bankers, Credit Suisse, and all the other tightening of the central bankers' capital reserve ratios that have forced me to have this behaviour. So, unfortunately, I don't agree with Sabine that the banks will be less difficult than 2008, 9, and 10. I think they're going to have a tremendous excuse and license to go and enforce and foreclose, whilst they can still see full recovery.
So I think Desmond, certainly that is a scenario. The reason why I'm a bit more hesitating about it is because, and by the way, I would agree with regards to new business, right? I think the existing customer relationships also for banks, because we speak to them, right, on a daily basis. And
well, they use the word variously. Sometimes you're a client, then you're a customer, and then you're a borrower.
Yeah. So, but the point is that they still, and at the end of the day, they are still in the business of lending, right? That's the primary business of a bank is lending. So what I'm trying to point out is that from my perspective, obviously there will always be some assets that they're going to bring to closure. Now, by the way, that's probably the last thing that the bank really wants, because what is a bank going to do with it, right? Now I hear you loud and clear, at least they can recover their capital, but then they still have to find another opportunity to go out there to put somewhere this money, this credit to work. So I guess, again, there may be some of those. Of course, there's always exception to the rule. But I think what, generally speaking, the banks prefer to do is, with regard to their existing facilities, is just to restructure them. Because like this, they kind of know the risk, unless they see absolutely no hope. They're going to definitely increase the margin they're going to charge to, right? And they're going to prolong as well the length of the loan as well, because it's also going to be profitable. And the rest of it, as long as they can, given that they are not in such a bad situations about 2008 with regards to, as you rightly say, how much of bad loan they have on their books, they can argue, okay, fine, we keep it, we just charge a little bit more. And I think that that's going to be the modus operandi for the vast majority of cases. With regards to new loans, I absolutely agree. In particular, and that's the sad news here, the small and medium-sized person, to your point about Credit Suisse, this is exactly the reason why, you know, the one hotel owner, the person who owns one hotel, who needs to refinance because he took up his loan maybe 2 years ago before COVID, right? And as we know, in 3 years' time, there's a refinancing situation. That may be a very difficult position if he's trying to go to a new bank, right? Because it's just going to be not important enough, and it is being looked at an additional risk factor. So, but again, I think we are saying, you see the world slightly in a more negative manner. I'm not saying that they're going to be there in order to not take advantage of the situation, but I think so far they seem to, as far as we can tell, hold on to what they've got, increase the margin, stretch it a little bit out, so they can still somehow, you know, kind of meet their, I guess, kind of, you know, internal ratios with regards to kind of potential recoveries. But yeah.
Well, I think 30 years ago, Kay Dimmock, then of JLL, coined the phrase "under-demolished" to describe the hotel sector of the what we would call distressed assets. Yeah, a lot of them are still around. So one hopes that the lenders make the distinction between, you know, great assets and stressed capital stack versus bad assets and no hopers. But we wait someone always comes in and rescues all these zombies, and I don't understand. Please don't do it again. Anyone listening?
There are enough debt funds out there.
Save our industry. Don't rescue the zombies.
Enough alternative funds, yeah. But I think also, by the way, there may be decisions taken by the bank whereby maybe in 3 years' time, from a legislative perspective, they will need to show 20% of their assets in their portfolio, in their books, need to have a certain level of ESG compliance in. If you no longer again meet those criteria, I'm of the belief that what is called green loan today, in a very short period of time, is going to be a very binary: you're getting a loan or you're no longer getting a loan, right? So I think this is all the things that, again, the industry, but not just us as hospitality, but real estate in general, is facing now. Absolutely.
Sabine, can I stay with you for my next question, seeing as we're talking about distress to some extent? How much is distressed inventory is currently on the market right now, and how long are assets taking to sell? And I want to follow this up with the question that we've had from the floor, actually. Question says, we have a distressed hotel in London, UK, near Heathrow Airport. We're planning to spend 2.7 million for a small extension and full renovation, but we're getting a problem of getting a valuation that can support for lending terms. So would you please share where we could obtain comparable data that can support with development cost for lending terms?
Okay, so so the two questions. So first, what is distress, or what level of distress are we? Do we believe that we are seeing opportunities coming through? Well, as I said before, but last year we were continuously about 15 to 20% below the asking price, and the vast majority of transactions did not transact. So in other words, and signs are now that these price levels are going to come our way. So I would have thought that, taking about a 15 to 20% approach is probably where we will see going forward. And by the way, we run the analysis, always obviously taking into consideration the additional costs, and obviously if going forward as well, the inflationary pressures and the like into consideration. So for us, a 20% discount is probably something that we would call kind of quote unquote distress. From a leverage, from a costing perspective for repositioning the asset, I mean, I really would have to understand which asset it is. As you know, we do redevelop assets. They come, as kind of a 2-3-star kind of assets to 5-star asset. So the amount you just mentioned, it really depends on the type of asset. Generally speaking, I would have thought if it's Heathrow Airport, at least you should have a very good demand driver there, right? So I would have thought that you should figure out, and depending on the type of hotel, that going forward, there should be enough demand for that kind of neighborhood normally, right? It's London, and it's a specific demand driver. But I'm happy to, if somebody wants to reach out afterwards, I'm very happy to look into more detail and to provide opinions. Where do we see, or where do we get the knowledge? It's all based on, I mean, we've been redeveloping hotels for the last 30 years. So depending on the location, the type of asset, the branding, we can tell you what normally the budget should be. Also basically take always the number that any of the brand owners is going to give you with a pinch of salt, because generally speaking, they try to undercook the numbers quite significantly, right? So that's probably the only other advice that we can give.
Thanks, Sabine.
Without knowing the details, sorry.
Yeah, and I'll say again that all the LinkedIn profiles of our speakers are in the chat, so I would encourage you to connect and carry on that convo. Claire, would you be able to shed some insight as to how that conversation and that relationship with owners, that dynamic, has now shifted with a view of how owners can best drive value and protect that bottom line?
Yeah, I think the conversation has shifted hugely, and I think previous lives, it was very, very top line driven. We would spend a lot of our time talking to owners about driving top line revenue, the success of that. There was a kind of a glory associated with driving those top line revenues. In the current climate, we are spending a lot of time talking about cost lines, how to creatively minimize it where possible. We're talking about energy solutions. We're talking about food and beverage costs. We're talking about labor turnover. And these are things that would not have been discussed in this minute detail with owners previously, because we ran on percentages. We ran on the same science that everybody else has been running hotels on. And I think as those lines have changed, as the focus has changed, that's changed the conversation. I think we have far more we put far more value on the conversation around cash flow than ever before. And we are seeing most meetings will start with that as opposed to anything else. And I guess that the upside for us is that we are seeing, and this is the benefit, the kind of silver lining, I suppose, is the value that owners and that we as operators are putting on team and stability, but much to Desmond's point about recognizing that great leadership drives great results, drives stability, drives consistency of service, which helps you drive rate, which helps drive everything. And our conversation around people is far more in depth now than it has ever been. And there is a real emphasis from owners on retention. How do we drive retention? How do we make people feel valued? Are we paying at the absolute top of our game? What does the internal progression look like? And that for me is brilliant. But that I personally don't believe that those conversations would have necessarily been happening at that level with owners previously. And I think the other option that we are talking about is I don't think owners are looking at them potentially just as hotels. It's just space. We talk about mixed use schemes. That wasn't even a phrase a while ago. People didn't, we talk about what else could we do creatively with this space, particularly back to Desmond's point about that kind of midsection. Traditionally is full of big conference and event space, which is why that market is struggling. They've got lots of underutilized space. What can we do with that to drive revenue in alternate channels? How more creative can we be if the inquiries aren't coming to us? How can we generate them? Those kind of solutions are being discussed far more. But it's team for me that is the defining piece. I think we're having much more conversation about retention. How do we secure talent? How do we keep them? And how do we develop them so they stay with us?
Mm-hmm. Thanks, Claire. Desmond, coming back to you for my next question here. We've talked about the opportunities, we've talked about the challenges, and I'm asking for you to almost condense that down into what should an owner do, or how should an owner navigate the next 6 months? Should they, for example, hold and retain? Should they sell and buy?
Well, obviously you should sell to us. And you should buy from us if we're actually selling anything. That's a very open-ended question. I think you as the owner needs to be really clear about whether the fundamentals of your asset in terms of its location, the market, the quality, the segment, the appropriateness of the branding, the operations, all the qualitative aspects about the specifics of that asset are quite important. But I guess we kind of go around in circle to come to the same point. I think there's going to be more distress driven on the capital stack than there is on the asset. If you've got, there's a well-known phrase, someone forgive me if I use the phrase, but you can't polish a turd, which means if you've got a bad asset, please do not cling on for dear life, hoping that refinancing it and changing the brand is going to make it any better. Okay, you have to deal with that and move on. I want to read a crystal ball about how and when you choose to exit that particular asset, but it ain't going to change over time, no matter how much you love it, or my wife comes around and chooses a new painting or a ceiling color or anything like that. It just ain't going to work. And you have to, and those are really tough decisions to make, particularly if you're emotionally attached, let alone financially attached. On the distressed capital stack, I do think you read the papers. I think Blackstone raised $30 billion last week for their latest fund. Starwood's raised goodness knows how much. Ares, all these people. There's loads of funds. There can be loads of evil capitalists at large, either to provide recap, rescue financing. If a loan to take from 60 to 40%, there'll be a whole new arena full of mezz refinanciers or prep equity refinanciers. I'm actually almost nervous that the plethora of that means that we might be able not even to play in that space because there's so much competition of people with dry powder not knowing what to do. I don't think anyone needs to sell unless you're a forced seller. Well, I'm talking about the good assets now, the good team, not the attorney team, the good long-term quality assets in good locations with great potential, with the right brand or ability to evolve that offering in the right market. You have to be super patient. As long as you can get your capital stack sorted out, then I think times will come good. I go back to the fundamentals, but whenever you get really depressed, staring at government security guards walking around in masks telling you can't use a building, before we find out 3 years later that masks had no impact, but apparently that's not on the front page news anymore. Whenever, just remember there are fundamentals. People want to travel. You can't buy a hotel room on Amazon. You can't have it shipped in a cardboard box outside your door. People will want to experience and want to travel and get to know the world. Goodness knows most agencies have made it difficult to make money. What I haven't yet figured out is why airlines are allowed to do dynamic pricing, and that's called proper yield management. We do, it's called profiteering. I think our industry PR is rubbish. We need to get out there more and be proud of the fact that in high demand, people are going to pay for the value and the exclusivity of accessing. I think the sponsorship of us as an industry in terms of labour support, lowercase l, or team support, of energy support. There's so much that could be being done if we had a proper voice. I think we're the third highest tax raiser as an industry sector, travel and tourism. Someone correctly said probably the second. And the amount of voice that we have and legitimate lobby in Parliament and government and our incompetent civil services is very, very disappointing. And I think that's, if you look through a 3-hour seminar, I'd be boring you for the next 2.5 hours about all the change we should be doing. So I would say hang on in there. It's a great sector to be in. You could have been in retail parks. Think about that. Or you could have been in flexible office space trying to compete with WeWork, whoever they are. Or you could have been in some dodgy buy to rent in Scotland that's now illegal. So in terms of sectors, I'd rather be in travel and tourism than any in terms of long-term macros. But goodness knows, the world's making it really hard to make a dollar here.
And maybe just if I just may add on this point as well. Sorry, Claire. I think this is exactly one of the rather positive things to really stress. If you look at the, I guess, INREF index of private real estate, right? I mean, at the moment, obviously, everybody saw, let's say last year was a complete, not meltdown, but a significant correction took place on the public equity side. So now everybody's very kind of, eagerly looking what is going to happen on the private equity side. And if you look at real estate, at least the last quarter, pretty much all of the other real estate asset classes are down, other than hotels. And I think if you think about it from my side, very humbly, I think it's now, you have to really think about what people want. And I think there's a shift happening here in society, at least the next generation. They're going from an ownership model to an experience model. So in other words, they no longer want to own their car. They're happy with an Uber or a Grab or a Toro or whichever service, because they just want to get to A to B. They no longer want to own their house because they're not willing to take their 30-year mortgage up anymore. They're happy to do build to rent, or, and then just change around a couple of times, right? They no longer want to necessarily own their desk in the office anymore. I mean, as we know, they have issues even going back to the office, right? But what they do want is they want to have more disposable income to consume and experience now. And at least our industry is exactly delivering to that promise, right? You have a generation, the next generation is more educated than ever before. They want to travel, they want to experience. So very much to what Desmond said, I think at least our as a class, compared to, relatively speaking, to some of the other ones, I think we're still, actually funny enough, despite COVID, I think we're coming out of this in a stronger position than our peers are doing in the office segment. I know I was quoted once this before, but this is true. If I look at some of my friends in, institutional, German institutional investors, very big, they say, Sabine, if I propose an office to our IC or a hotel, I get more questions being asked on the office side nowadays. So, and this has never been like this before, right? So life isn't that bad. And I think also people are coming around to the notion that the old mantra of just buying a brick and mortar thing and putting a 20-year lease on it and sit back and relax and be passive, it just no longer works, right? You have to embrace the operational side, and that brings you to hotels, right? So I do see a bit of a silver lining at the end of the day. Sorry to interrupt, but I thought that's, it's not all just doom and gloom here.
I think this might be the one point that we all agree on, because I sound like a broken record, but we need to have a better PR campaign. If you look at securing talent into this industry, we do ourselves no favors at all in terms of making this look like a great career path, one that you can interchange from other sectors, one that teaches you skills that you won't find anywhere else. We don't do a very good job at that, and I think not only is hotels a great place to be operationally and from an investment perspective, but from a career perspective, there are stories. This webinar is full of people who've got great stories about working in hospitality, being in hospitality. We're just not very good at sharing them. And for me, that's a big challenge. Back to the point about securing and retaining talent. That's what we need to do. Sorry, slightly off point, but I was agreeing, just the long way around of doing it.
I'd like to finish up with some questions for Sabine on the ESG component of this conversation. You brought it up earlier, but I think it is worth mentioning. Do you think, or Sabine, how does ESG affect that scalability and valuation? And perhaps more importantly, is it becoming a factor in the movement of distressed assets?
So from our perspective, it certainly is. And I think that with the, I guess, experience that we hold, in-house on the ESG front, for us, okay, because we started off with ground-up development, we always were very, I guess, very much alert to ESG and the importance of such. You talk to any valuer now, you have case studies out there, same asset without ESG compliancy, there will be a slightly higher cap rate being used than for the same asset with an ESG compliancy. By the way, whatever that ESG compliancy means, because depending on which jurisdictions you're in, and obviously there are different rating systems, but I guess that the general sense is certainly there. And by the way, Desmond, I would agree as well with your opinion about, what values are doing, is because the better the trading of the hotel seems to be, the higher the cap rate they seem to put on top of it in order to somehow kind of add up where they were the year before, just in order to be on the safe side. But anyway, I think ESG is coming through more and more. It's also, as Claire said, it's an important element as well from a recruiting perspective. The next generation is very much conscious of those things. And, if you are simply, having an old asset, and majority of the assets in Europe are old and obviously dated, and not willing to do anything about it, I guess your chance of retaining good staff is also inferior to those who actually do worry about it and try to do the right thing from an environmental perspective. And then obviously it's not just the E, the environment, but it's the S and the G. And again, being in hotels, it's actually one of the best segments or sectors to be in, to show the kind of the social side as well, because we are involved in the operation of an asset, because we can create career ladders for people who may not have necessarily gone to university, but who may want to start somewhere, and then who knows, maybe do university afterwards and then come back. We have a lot of flexibility. You can go across borders and the like, and certainly do things that is, I guess, harder to be achieved in some of the other sectors, in particular in real estate, right? So certainly from our perspective, significantly important. And as we now hear, quite actually outspoken from some of the biggest, I guess, institutional investors globally, there are a number of assets, not just in hotels, but in general, that do become obsolete. And it's just, if in Europe, it's more, I say, because of the EU taxonomy and the like, and now also the reporting requirements and ever-changing kind of requirements, and not everybody, including myself, always really understand exactly what's the latest update. But the point is that institutional investors are very conscious that if they're not compliant with a certain level of ESG standard, they would have to pay a fine to the regulator. And that is obviously a huge risk for them. And as a result, they just try to be on the safe side. So we see it now from an investor's perspective. We see it on the, as I mentioned before, we see it on the banking side. We see it even on the insurance side. So we see the importance of ESG pronounced. We see it on the staffing side, all across. And as a result, it is CapEx that people have to invest, but it is something that's paying out over time.
Mm-hmm. I'm going to ask each of you this final question that we've had from the audience, and it's quite general, it's quite wide, but I'm going to say, can we have the panel's insight on one actionable takeaway that owners can take away today that they can implement and improve their service?
Their service or profitability?
Improve their services.
Well, I'm going to say you're going to find a way to get people to come direct to your business. That's the biggest, the biggest challenge is only bigger than the last one we came up with. So we are, as hoteliers, beset with big challenges. But an earlier point I made, the constant scraping of my hard-earned income by the third parties, whether it's OTAs or brand and their inefficient sales support, or system funds, whatever they call it, and or Google Click, and all of the above, means I just sometimes wonder who's doing all the work here and who's getting all the reward. And so finding a way to get your customers to love you enough they want to come and book direct and save you a lot of money, I think is the best way to get instant impact on your own profitability. And services, it means having CRM lets you tailor the experience to the next visit, gets you a personal connection, which the customers always appreciate. I'm always interested. See, when I stay at hotels, I stay at quite a lot of competition just to see what they're like. It's quite interesting how different they are in follow-up. And some just want you to fill in some TripAdvisor tick box and 5 stars, whatever. And some are actually quite more emphatic about presenting opportunities to come back and spend more money with them again. So it doesn't cost you anything because you're saving money. Just find a way to customers to book direct and stay in touch with them.
Thanks, Desmond. Claire, coming to you next on that one.
I think my answer would be to look at the people. I feel, I know I sound like a broken record, but I feel really passionate about getting the right leadership at hotel level, and a great general manager can literally change your life. And having one who understands your objectives and understands your experience-led guests and understands how to drive retention and who is well motivated and well briefed is brilliant. And they are out there. Sometimes you have to go and steal them and poach them and pay them and all those good things that we all do. But finding someone who really understands your location, the experience we're trying to deliver, and your objective as an owner is massive.
Thanks, Claire. And Sabine, your take?
Sure. On Desmond's point, I absolutely agree. I just think that the direct access to bookings, if you have a number of hotels like obviously Desmond has, that obviously is a bit easier to do than if you're just a single asset owner and still to some level at the mercy, I guess, what the brand owner wants to do with you, who put the brand on top of your hotel or whatever the OTA wants, right? So, but I agree, if you can crack that nut, obviously significant savings. I think the one thing I want to say that I think you can implement if you're a single asset owner or if you have a portfolio, doesn't matter which brand, whatever, greener stay. So all it takes, and it costs you nothing, all it takes is train the person on reception to say on check-in, and by the way, as you would like to most likely be environmentally friendly, we decided to not clean your room unless you specifically ask for it. And I can guarantee you, if you do it the right way, nobody's going to specifically say who's going to stay there for like 1 or 2 nights. No, I absolutely want my bed linen to be done, and I want this because, I mean, who's having the bed linen changed every day, right? So I just think it's a question of how you train them. And the issue is at the moment that, I'm honest, the majority of the brands that I know, the majority of hotels you're going in, they don't tell you on check-in, but then you have, it's, you come into your room, you have thousands of leaflets around, and you have to find the one that you then have to, put by a certain period of time outside the door so that the housekeeping knows that this room tomorrow doesn't have to be cleaned. I don't understand. Just say it and check it.
Well, two things to me. They cut down trees to put the paper collateral on all the desks.
Exactly.
A brand who I won't embarrass, we finally encouraged them to offer alternate day towel change, which they finally embraced, but then realized their brand didn't have towel hooks in the bathrooms, which we had to point out to their technical service department. So, we're all equally unjoined up. I think. The interesting thing is that we offer that in some hotels and also give people a £10 credit to spend on the bar in lieu of that. And guess what? Spend more than £10.
Exactly.
Go to the bar.
It works. You have a better revenue. You have a happy client. You're saving on your cost from a housekeeping or cleaning perspective, and you do the right thing by the environment. That's why I'm saying
Our vouchers on recycled paper, I should add, just
as well. Yeah. Well, the next one is going to be, online. The next one will be online with the QR code.
Well, we've got some various different responses to that last question, so I'm glad we had the time to ask it. I just want to say thank you to Claire, Desmond and Sabine for your insights today. I've just got some closing slides that we need to run through before we finish off this webinar. I want to flag a webinar that I'm actually hosting next Monday on the 24th of April. It's called Global Investor Sentiment, and it will be touching on pretty much everything that we have touched on today, but broadly speaking, within the urban living environment, so covering different asset classes such as the extended stay, co-living, build to rent sectors too. So if you're interested, I would love to see you there. You can sign up to that webinar using the link that has been popped into the chat. And if you're interested in working with us, you can get in touch with either of my colleagues, Katie or Steph. Their details have been popped up on your screens now. So all that's left for me to do today is to say thank you once again. Thank you to Claire, Sabine and Desmond for your insights. This webinar will stay open for an extra 2 minutes to allow our audience to follow up with any of the links that we've popped into the chat. But all that's left for me to say is thank you, bid you farewell, and I will see you next week for my next webinar on global investor sentiment. Take care, guys. Bye.
Hello, we are International Hospitality Media, or IHM for short. IHM is the #1 brand to engage with decision makers in hospitality and real estate. Our 4 multimedia brands lead their respective sectors with breaking news, comments, trends and opinion across a variety of multimedia solutions. We provide an inspirational community to connect people through world-class events, webinars, podcasts, award schemes and much more. But let us share our story of who we are and what we do. Over 10 years ago, Piers & George had a light bulb moment to provide expert opinion, comments and no-cost digital content. And so they went on a journey over the past decade, creating media platforms to serve the hospitality and real estate industries. We now have an engaged audience with a reach of over 60,000 monthly visitors across our websites, 41,000 on our email database across all the sectors, and over 67,000 across our social channels. Everything we do believe in challenging the status quo. We believe in thinking differently. We make things simple and very easy to work with us. And we're a friendly bunch too. We offer creative solutions to help you achieve your business goals. Read, watch, listen, meet with IHM. Contact us for a chat today. Just look at some of the brands we have worked with recently.